Today's lesson is on marginal income tax rates. I'm sure we're excited to talk about taxes today, but as a financial planner, what we're doing is we're looking forward with tax rates, and we want to look to the future and give advice to our clients, give advice to you in some moves and some strategies that you might put in place now to minimize your taxes. So let's look historically here at a single person earning $50,000 a year, or a married couple together earning $100,000 a year, what tax rates. So back in 1980, this is the year I went into business, a single person on $50,000 on their last dollars, they paid 55% federal taxes. And a married couple at $100,000 a year, married filing jointly, paid 59% just to the feds. That doesn't count the states. So you go down, move ahead 20 years to the year 2000, those numbers were 28% and 28% on their last dollar. For people making substantially more, of course they were more, but I'm trying to take what are some average folks here, maybe a little bit above average, but pretty much average folks. And in 2020, this is post the Tax Cuts and Jobs Act that passed a few years ago, the marginal tax rate for these people are 22% in either situation. That means on the last dollars that they earn, they're paying 22% taxes. And it's been my experience that most people don't know this. They just measure their tax rate by whether they get a refund or not. And when you look at that, I mean, on the one hand, that may seem high to you when you're sitting there looking at it as knowing almost a quarter of every dollar that you earn, or of the last dollars that you earn, is going to the government in taxes. But if you look historically at what it's been, tax rates are as low as they've been really in my lifetime. And they have a sunset clause in this Tax Cut and Jobs Act. So when they passed it, it only goes through 2025. So the tax rates are going to automatically go up to 28% at these levels, or another 6%, and that's way more than 6%. It's like 25, 30% more in taxes, and that's assuming they don't mess with the legislation. And if they do anything, they're going to be raising taxes in the future, in my opinion. And you need to decide for yourself where you stand on that. So the common wisdom and the conventional wisdom for retirees or people in retirement is you defer taxes or you avoid taxes during the earning years when you're at these higher rates, and you're going to be at lower rates in retirement. And that's kind of proven true for those of you that are right at retirement. I'm asking you now to look ahead to the rest of your retirement and think about, do you think tax rates are going to stay at this level, or do you think they're going to go way up for people that are earning, a reasonable or average or above average income? And my feeling is that they're going to go way up. So why am I teaching you about this? Well, it's real simple, is that you've got an opportunity, and perhaps the window is open for 5 years, so you could spread this out over several years to actually pay the taxes now on your IRA money through a Roth IRA conversion or a Roth 401k conversion. Or to roll it into an IRA and then from there do a Roth conversion. So when you really look at the numbers, a lot of clients go, what? You want me to pay taxes now when I can wait and pay them later? Well, yeah. I mean, especially when it's at these rates, and then it could become a tax-free account instead of a tax-deferred account. So we're going to measure the success of our retirement planning and how much money that you have left or your heirs have left, if you're planning on leaving this money to them, of spendable money, of useful money. So that's today's lesson. I'm Hans Scheil. I've written a couple of books on these subjects, and I thank you for listening.